Okay. How we doing, everybody? Awesome. So my name is Amanda Fabiano. I am the owner of Fabiano Consulting, a firm I just launched to help miners with their strategies after a decade-long of experience in financial institutions focused on mining. With us today, we have a few people to talk about what we're all thinking about and what's on our mind, which is the halving. Really big times in Bitcoin. So first up, we have Zach Bradford, who is the CEO of CleanSpark, a NASDAQ-listed public mining company in the U.S. They have a $572 million market cap. They started as an energy company, transitioned into a Bitcoin mining company, and they've continued to grow at a rapid pace, I would say, especially over the past year, making many strategic infrastructure investments and acquisitions. You have 9.6 exahash under management, and you have maybe 6.5 sites we've decided backstage. So Zach also will be tomorrow on the stage sharing some of the strategy that he has at CleanSpark on the orange stage, so if you want to check him out there too. Next up, we have Charlie Schumacher. Did I get it right?
You got it.
Amazing. Charlie is the VP of Corporate Communications at Marathon Digital Holdings, and Marathon is also a NASDAQ-listed public miner. They have a $1.48 billion market cap. They have 19.1 exahashes spanning across 7 sites globally.
Yes.
Yes, Charlie, looking forward to your insight today.
Thanks.
And last but certainly not least, we have Charlene Fadirepo.
Hello.
Charlene is the CEO of Mango Digital Strategies. It's a consulting firm helping companies integrate Bitcoin into their businesses. She is a former U.S. regulator and banker, and is very active in the West African landscape related to Bitcoin mining.
Thank you.
You also have a podcast where we can learn more about the landscape in Africa called
The Bitcoin in Africa Show.
Yes, awesome. So I'm very excited to be here today with these 3 guests.
Great.
So we're approaching the time where we all lose sleep about the halving. We have to think critically at 3 a.m. about what our strategies are. I think, the halving's less than 200 days away. Revenues are going to be slashed. Hash rate is continuing to rise. Does that sound right? Yeah? Okay. Mm-hmm. And the macro trends around capital deployment is still quite challenging. So what are some of the changes that we've seen from the last halving cycle, and where are you focused on? Zach, we'll start with you.
Yeah. I think this one is set up to be probably the most interesting. I'm one of those people that do believe in the cycle. I do think that, supply and demand will always take effect. It will affect Bitcoin's price. So I think that we have, a good future, but I think that we have bumps in between that. And hope is not a plan. All of us hope Bitcoin is going to go up, but we need to be prepared for the worst. And it's about which companies are set up to weather the storm. I think a unique impact that this halving has in something maybe we'll talk about later, but the ETFs. There's a lot of new capital that is likely to enter the market, and it's going to be new in a way that we don't know how it's going to affect Bitcoin. And again, I think it's going to be for the positive. But if you haven't prepared for the worst, I don't think a miner makes it through this next halving cycle. The best part about Bitcoin is that it pushes for efficiency. At all times, it's always driving to squeeze out efficiency. And so I think that that's going to have to be the focus, and it's something that can't be done overnight. So it's miners are either going to be prepared, and they're going to be ready to go, or they're not. So.
Charlie, what do you think?
Yeah, I obviously agree with a lot of that. Everything's about efficiency. I do think that something that's interesting is this is kind of the first institutional halving that we've seen. So in the last cycle, there were no large publicly traded Bitcoin miners. Now there's several of them.
34% of the network now.
Yeah, so it's gone up a little bit. And I do think that the principles are the same. It's you have to be as efficient as possible. And we've seen that trend continuing. But I think, we were I think the average efficiency of the Bitcoin network was like 58 joules per terahash going into the last halving. It's closer to 30 now. And so, and the machines, although they are getting more efficient, they're doing so at a decreasing rate. And so I think the game is the same. It's the same about lower your costs, deploy the most efficient equipment you can, except it's becoming much more sophisticated and a lot more difficult to get there.
And Charlene, what are some of the trends that you're seeing that miners are taking in Africa?
Yeah, I mean, I think that we heard it earlier. A lot of miners are really focused on jurisdictional diversification. So if you think back to the last cycle, May 2020, roughly 65% of the hash rate was in mainland China. June 2021, the hash rate moves from China. It goes to the UK, the US, Canada, Russia, and Kazakhstan. When we hit 2020, we realized that these were very difficult economic times and energy costs were very, very high. And that has allowed both public and private miners to start really thinking of where can I get that low cost energy. What we're seeing is that originally that was the push toward Latin America, but we're also seeing a push toward Africa. So East Africa, West Africa, and South Africa. And I think that will continue. When you combine this idea of low cost energy with the opportunity for renewables, you really can create the best conditions for a profitable mining business.
Mm-hmm. So speaking of profitable mining businesses, we see hash price continuing to rise. We see new machines with crazy efficiency jumps. And, you know, how will miners survive with their revenues about to be cut in half? What strategies are your companies taking or that you're seeing companies take?
Well, there's a line I'll steal from one of my colleagues, Adam Swick, which is that someone will always make money mining Bitcoin because hash rate and then therefore difficulty rate is dynamic. Mm-hmm. So what matters most is actually, because mining is a perfectly zero-sum game, that you are in the low half on the cost curve and ideally the bottom 25%. So again, it being like all about efficiency to get there. I think if you're on the very low end of the cost curve, like you're good. So at this point, what should you probably be doing? Well, probably shore up your balance sheet and look to grow as much as you can. And try to do that now, or put yourself in a position where, if you're interested in buying assets, that you have the balance sheet to do it, because stuff may go on sale for the people who can't survive the halving.
You know, maybe I'll add on top of that, because that was a strategy we took halfway through the cycle, was to buy the assets when they were cheap and not buy them when they were most expensive. But to make sure you were buying assets that were incredibly efficient. But efficiency is only half the equation, right? It is, we keep mentioning power over and over again. That's half the equation. Efficiency is the other half. I really do think you have to be at the bottom 25%, and then you need to plan for the next halving. So we were thinking about the halving coming up in 200 days 3 years ago. And we're already starting to talk about what we expect about the 2028 halving. We won't really make any moves towards that until probably a year into the next cycle. But I think that that's how far that, especially big companies, public companies like ourselves, we need to be thinking 3 years out before every single halving at a minimum. And I think that's the only way to continually improve. Something that's also going to be interesting with hash price and the efficiencies we mentioned is there now are these giant fleets that have developed amongst public companies. That means there's now a giant fleet that a few years from now will be less efficient. And a big part of capital management on this is going to be, what do you do with that? It doesn't make sense to just sell and buy new machines every 5 minutes. That's where we think that there's a strategy. Now, talking about different jurisdictions, there's going to be places where in the U.S., a very efficient miner works great. 3 years into it, when it's less efficient, where am I going to go plug that in? Or am I going to sell it to somebody else? We would rather take it and either keep it plugged in to end of life where it started, or move it to a new jurisdiction. And that involves getting creative into kind of the microgrid side of things, so that there's opportunities, for example, in Africa developing. I think that there's going to have to be unique places where kind of the second-tier miner continues to live.
Is that what you're seeing in Africa?
It is. And just in terms of survival tactics, I think there are 4 C's. There's cost, capital, creativity, and clocking. So very similar to what you guys said. First thing is cost. You need to be mining at the most low-cost place possible. And even if you are in Africa or in an area with a low energy environment, you need to make sure you're locking in that power, doing power purchase agreements, or making sure that you have a renewable strategy. From a capital perspective, we're expecting this is the time that miners are building the war chest, They're cutting back on investments. They're not overextending themselves. They're trying to make sure they have enough extra reserves to last the long haul. From a creativity perspective, and we haven't really gotten into it, but miners are being super creative with revenue diversification. You see miners in ordinals. You see some miners opening repair shops. You see some miners doing derivative hash rate. Anything to bolster those revenue streams that are coming in. And of course, clocking, that's kind of a nod to efficiency. Do you have an efficient fleet? Can your fleet last for the long haul? So those are the things that every miner, public or private, needs to focus on to survive.
Yeah, speaking of incentive strategies going forward, right, and changes in strategies, there's definitely some vertical integration that we see happening more broadly across the mining industry, and certain groups have decided to, jump into different areas. When you think about vertical integration, how has that become a key differentiator, do you think, from one company to the next? When we think about entering into new verticals, there's risks that go along with that, right? So how do you, as companies or companies that you are watching, evaluate risks as a miner and think about, like, is this the right time to jump into this, or should we kind of hold back?
How I think it's important to look at is ultimately what underlies that diversification strategy or the integration strategy. And that's one of control and flexibility. That's what a miner needs to be able to do. They need to be able to control when they mine, when they don't mine. They need to be able to control their supply chains. They need to be able to have a control in all of those things. But on the flip side of that control is sometimes a lack of flexibility. If I own a facility that manufactures a transformer, let's say, and I now have the control of ensuring I have that transformer, well, I've now lost the flexibility around maybe my labor force that's associated with that, maybe my capital that's required to go there. So I think that what we're really going to see, and I think that this is the real important thing, whether you're big or small, and how you integrate all these pieces together, is which ones add control, which ones add flexibility, and how do you balance that? I think we're going to see a lot of flavors develop, but that's what we're paying attention to, and I think that's what's ultimately going to prove out that matters the most.
Yeah, everyone sort of has a little bit of a different strategy on that among miners. So like mining itself is commoditized, but the way that people approach mining the commodity is all a little different. But I agree that a lot of it is about controlling the variables that you can. So none of us control the price of Bitcoin, which means none of us actually control our revenue, right? Which is crazy as a business. How do you plan for that? Well, you can control actually quite a lot on the cost curve. Part of that is when you're looking at new sites, looking for the cheapest electricity you can find, and ideally renewable, right, especially if you're a publicly traded company. But the other side of that is you can control your technology. So something Marathon's done is we were very asset light for a long time. That's kind of what we were known as. In a bull market, we basically just wanted to buy revenue generating assets so we could grow and get as much hash rate online as possible. As you transition into kind of where we've been the last couple of years and kind of prepping now for the next halving, we're looking to control as much of the cost on the technology side as possible. So that's, we run our own pool, for example. So if you can reduce latency, that gives you like a little bit of an extra edge. We've been developing our own firmware. So talking about being able to overclock or underclock your miners depending on market conditions. We have proprietary immersion technology, which has also been something that's really valuable for us. Also speaking about going into new markets, that opens the door for areas that previously you couldn't mine in because of air-cooled machines. So we really think that the technology component of mining is a really important place for people to be focusing their attention.
So is the hosting model dead?
I would say it is. And I think I'm going to go back to actually why I think it is, and that's because Bitcoin as the algorithm, it's seeking out efficiency. A hosting model is an inefficient model. You have two parties that need to split a revenue stream now to try and make it. And again, making it isn't good enough when you come into really hard times of halving. You have to be thriving up to those tough times so that you can make it to the next stage. That's why I don't think that mining lives a long life successfully. I think we're going to see it come in, come out, but I think that it becomes this very short cycle with a lot of failures involved. I think it's more likely you see things, if there are going to be two sides that work together, it's going to be in a joint venture where they properly share the revenue stream and they share the exact same incentives. and that is efficiently generating the greatest return, as opposed to just selling power or just selling a hosting labor force along with it.
Well, if we dig into that for a second, right? When we saw the China ban happen, which it was the change, right, in the last halving, really there wasn't a ton of opportunity other than hosting, right? Like there were people who had infrastructure already built out. If you wanted to become a miner, you didn't want to wait 18 months for a transformer. You wanted to host right away. So you were willing to give up some of that profit because you were going to make money on the other side. Now, that structure works for some people, right? And that has made a lot of groups a lot of money, but it adds this third-party risk dimension that becomes extremely important, and that's what we saw play out over the last 2 years, right? We had the perfect storm where energy prices were increasing. The hosting companies had all of the power at that point. You didn't say, like, show me your PPA. It was, this is the price, and if you don't want it, someone else will take it, and they might take it for higher than you, right? So I think that model has shifted. My personal take, and I know I'm the one asking the questions, but I do still have takes. My personal take is I don't think it's dead. I think that the risk will be adjusted, and that you'll have to have really good financials on the other side in order to make it work, right? So that you don't end up in a situation where your host becomes bankrupt.
Yeah. I was going to agree. I think hosting is not dead. Hosting has just evolved, right?
It needed to.
Exactly. There are opportunities to host in East Africa and West Africa, but the terms of those agreements are very different, and they're going to continue to evolve. And that's what we want. I think your point is well taken. Hosting was the best option because most folks did not want to take the time or spend the money to enter a new market. Now the entire industry is way more mature, so you actually have options as to how you want to enter a new market.
Yeah, the answer is both, right? The old model of hosting, I do think, is dead, where you have three parties involved. You have someone who brings miners to the table, you have someone who brings power to the table, and you have someone who builds infrastructure who sits in the center. The margins are getting too compressed for all three of those people to exist. Yeah. So that concept, I think, is going away, except maybe in places that have super, super cheap energy. What I do think, though, the way it's evolved is that kind of what Zach was alluding to, which is the principles that people who have different expertise will work together and bring different expertise to the table. That's still very true. Mm-hmm. So that's this sort of JV structure that Zach was mentioning. And if hosting does work, hosting and power should be the same person, right? The host should be the energy company.
Yeah, I think it's also just more people have gotten into mining and now understand that energy is really like the center of it all, and there's more people working in the space. So the structure has changed because everyone got smarter over the past 4 years.
Yeah, it's interesting. I've really struggled with this question in Marathon of like, who is our customer? And because technically we don't really have a product that we sell, which is like the weirdest thing in the world for a business. And for a long time, I thought that maybe the Bitcoin network is our customer because all miners provide a service to the Bitcoin network in form of security. But as you and I were talking about earlier, I'm starting to shift my perspective, and maybe it's that the customer is actually the energy sector, and that Bitcoin miners are technology solutions for energy providers. So if that's the case, the host power company, those should be the same person, and then miners provide technological solutions to help them make themselves more efficient or basically build new infrastructure out.
And you're seeing that, right, in different landscapes?
Yeah, we're absolutely seeing that. We're actually absolutely seeing that in Africa, and I'll just do a quick segue. So one of the models that I'm most excited about is Bitcoin mining as an anchor tenant. And we're seeing that Bitcoin mining used as an anchor tenant to subsidize the cost of power. So earlier actually 2 weeks ago, I was in Nairobi, Kenya, touring the gritless. There's a company called Gritless Compute. They're Kenyan. They have pioneered the combination of hydropower and solar power to solve for energy poverty. So basically, roughly 500 million folks across the continent of Africa don't have access to sustainable electricity. But when you bring Bitcoin mining into a power equation, the economics of that deal just make sense. And I think we will continue to see really unique models that work that way so that we can push toward global energy abundance and also solve for and help push companies or push countries toward renewable energy, but also lock in low-cost power.
You know, I would add to that because I do think that's the reason that we got out of the energy business. We sold a microgrid business because it was so hard to get funding. Yep. Because the anchor tenant was generally in a business or set up as a community or campus that they were looking for savings. We're so uniquely positioned to generate revenue without the waste between the output and the input when it comes to energy, that funding of energy projects as an anchor tenant really is the way to create an abundant energy future. And that's what got us into Bitcoin in the first place. So I'm really excited to see that this is happening, because I do think that it's an answer for energy to actually be developed in places that wouldn't otherwise be.
Perfect. One question left, 5 minutes left. What other macro trends do you think will affect mining going forward? So we talked a little bit earlier about the ETF. If it's approved, how do you think mining stocks will trade? Do you think that operations and thinking about like a mining operation will be like the real clutch going forward to assess if someone is good to buy or bad to buy?
Yeah, I think the ETFs are going to be a stamp of approval upon Bitcoin for traditional markets in a certain way. And, one of the fears could be that a capital moves out of mining stocks. But I don't think that's the case. I think there's so much latent capital that's going to be brand new to the space that goes into the ETFs. I think that instead we're going to get more capital to every sector that's connected to it, whether it's a power company that serves a Bitcoin miner or a Bitcoin miner that operates in the space. And that's ultimately the stamp that traditional finance needs. Is it's this really easy way for it to be introduced, generally accepted by financial advisors. So I think that that's going to be a really big catalyst that happens. Now, I think mining stocks, of course, will benefit, but I do think that the reason they're going to benefit is they'll now be seen differently in what they really are in a true light from an investment point of view. It's a leverage play. Bitcoin miners are really, mining Bitcoin is the only way to acquire Bitcoin cheaper than you can buy it in the market. I'm sure you can do the derivatives around it, but really, if I want a Bitcoin, and I want to get a block, and I mine it, and I can mine it for my all-in cost, let's say, is $15,000. That miner is the only person on the planet at that moment that can buy it at $15,000 right now. So that's the reason that Bitcoin miners will continue to have value, because of the leverage that they have.
Yeah, I mean, gold ETFs exist and gold mining stocks exist, right?
Yep.
So yes, both can exist in the same world. I think the question is, assuming an ETF gets approved, is that pie going to stay the same size, in which case investment moves away from Bitcoin miners into the ETF, or is that pie going to grow? My personal take, and I think probably all of us agree on this, is that the pie is going to grow, because it's going to because if you think about it today, your choices in getting exposure to Bitcoin are you can buy a mining stock, which is volatile and has a lot of beta. Traders love that. Some long-term holders don't like that. You can buy Bitcoin outright, or you can put it on an exchange. This is maybe like heretical to say at a Bitcoin conference, but I don't think most people want to hold their Bitcoin. People don't want to run the risk of vaporizing their net worth. Like, there's a reason that banks came to existence in the beginning, right? So if you have a new financial instrument that is super familiar to people, that allows them to get exposure to Bitcoin without running the risk of vaporizing their net worth, I think that does pull a lot of new people into the space.
I think, said in a different way, you have the option with Bitcoin to hold it for yourself or to have someone else hold it for you. And that is like the real, I think, value.
Yes, the option is what's important, right? Yeah, agreed.
Outside of the ETF, are there any other macro trends from a regulatory perspective that you think will affect miners going forward?
Indeed. I'm just looking at the regulatory landscape around the world. If you look on the West, the U.S. and Canada, they've had some pretty tough and aggressive regulation with regards to mining. We've had moratoriums in New York. We had Bitcoin mining moratoriums in New York and also in Canada. But if you look in the Middle East and Africa, you're seeing favorable jurisdictions and also supportive governments. Just this year in Nigeria, they passed a new Electricity Act, which means individuals can produce up to 1 megawatt of electricity without a license. So you see the entire Nigerian government being open to renewable energy. You're seeing, there's projects in El Salvador where the government is partnering to provide Bitcoin mining sites. There's huge sites. There's a huge site in Oman where the Oman government has sponsored $1 billion budget for an 800 megawatt facility. So again, you're seeing government saying yes to Bitcoin mining, and you're also they're saying yes to private investors, and they're creating the regulatory structures to make sure that these ecosystems can flourish.
It's the beauty of Bitcoin, right? It's completely decentralized, and you could use it and mine it wherever you want.
And Bitcoin mining follows the path of least resistance. So we will see public and private miners move to those places that make the most sense for the business.
Yep. Awesome. Well, thank you guys so much for your insights today.
Thank you.
Oh, thank you.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.